Hello everyone, my name is Clément Gignac. I'm the Chief Economist and Senior Portfolio Manager with IA Financial Group. So over the next 5 to 7 minutes, I will try to summarize the webinar that we have just recorded, that we talk about the big picture. We made the Post-mortem 2017 and we share our view and the strategy for 2018. If we made the Post-mortem 2017, it would be a significant year, and as a matter of fact, it's the first time in the last 10 years that now we have a synchronized worldwide economy. In the past, you have always a country with experimentation, but this time all the countries in the OECDs and many emerging markets experiment positive growth. So to have all the style aligns is the first time that we have all the countries contribute to the economic growth. So it's significant. So it came at no surprise when you have such even the first synchronized worldwide economy in a decade that we have a pretty good vintage in terms of capital market. Whatever is the bonds or equities, they have experiment in fact positive growth. In terms of equities, yeah, Canada has posted close to 10% growth in terms of TSX. In terms of return, but if you talk to US, it was closer to 20%, and if you talk to EFI, 25%, emerging market, even 35%. So it was a very significant positive vintage as far as equity is concerned. And what was very interesting and at the same time unusual when you think about that is the absence of volatility. So we have not seen any significant correction. As a matter of fact, it was 14 months in a row, in fact, since the election of Mr. Trump, that each month has a positive return in Wall Street. Such sequence, 14 months non-stop positive growth in terms of a positive return on Wall Street. It's the first since the Second War. So that tells you something. If we look for 2018, it bodes well in terms of big picture. We see Japan now start to coming out from the stagnation that we have experimented over the last decade. Europe, since the election of Mr. Macron in France, we have no longer concern about Euro breakup. The business confidence reached a new high, consumer confidence too. So we have a very good momentum in Europe too. And as far as China, they continue with the business model change. It's now more driven by consumer, more driven by middle class rather than just capex and exports. So it's more well balanced in terms of economic growth in China. Back to US, the economic cycle continue. As a matter of fact, now US has experimented 8 years of economic growth. This is the second longest business cycle in US since the Second War. And we do not see any recession anytime soon. We think that the US economy will continue to grow for many quarters. And in addition, with the new fiscal plan of Mr. Trump, they will stimulate further the economic activity since they reduce the taxes for the corporation. So we will see more capital spending in US. So what will happen with interest rate in such environment? It came as no surprise that normalization of interest rate will continue. So we do not see too much interest rate increase. We talk about 50, 75 basis points increase. From historical point of view, it's nothing, but nonetheless, they will have some increase of interest rate in US. In overseas, Japan and ECB is probably more story for 2019 when we talk about interest rate increase. Back to Canada, this economy surprised everybody, including myself or the governor of Bank of Canada. Canada, who has shifted from the worst in the class 2 years ago, now lead the podium in 2017. They post more than 3% GDP growth. In terms of job creation, over the last 12 months, it's more than 400,000 job creation, and most of them is a full-time. We cannot explain the strength and the resilience of Canadian economy without reference to immigration. This immigration is significant, and they contribute to the wealth creation overnight. It's very, very interesting for Canada. In terms of Bank of Canada, they will have no other choice in 2018 to, in fact, increase interest rate, we think they will match the interest rate that we see in U.S. side. As a risk factor for Canada, you have two risk factors. The first one is regarding what happened in the real estate with the new macro-prudential measure. They will have a stress test for anybody who want to buy a new home, so there will be some impact. And the other stress test or uncertainty, I would say, it's regarding the NAFTA. What will happen to the NAFTA? Because we know that Mr. Trump want to renegotiate that, so it's some uncertainty. As a result, you will see some volatility on Canadian dollar, but remain optimistic that at the end of the day, we will have a deal, whatever is NAFTA 2.0, but we will have, in fact, a Canadian dollar who will probably finish stronger the year than weaker. As we talk, it's around 80 cents. If we go to the capital market, summarize our strategy, of course, we have seen a very nice run on the equities since 2009. Since the 12th of 2009, the S&P 500, which is the Wall Street barometer, has increased by more than 300%. They trade now at 18 times forward earning. Is it a bubble? We disagree. We think that yes, that reflects the strength of the economy. And if you compare not the current level of stock market to the trough, but the current level to the previous peak in 2008, in fact, the market exceeded by 60% the peak of 2008, which is by historical standard more or less what we have seen in the past. So as long as we see the economy continue to grow with a significant earnings growth, we expect this year another double-digit earning growth in U.S. We think that you will have a positive return. Yes, we are a little bit more prudent. We think that is probably more single-digit return to expect on Wall Street rather than the 20% that we have experimented. But nonetheless, we remain positive. We are more optimistic regarding the IFI. If you compare, for example, Europe and Japan to the U.S., it looks like that the U.S. stock market or U.S. economy is the 8th inning. If I make a parallel with the baseball sport, if you want, we are on the 8th inning with the U.S. and we are probably in the 5th or 6th inning with Japan and Europe. Eurozone. So that's the reason we try to take profits on the U.S. equities in our strategy and diversified funds I manage for IA and IA Clarington, but we overweight more the IFI in terms of equity. Anyhow, we think that it will be a good vintage 2018. The bad news is probably that you will see the normalization interest rate continue, so probably the bond market will suffer more. So we invite you at the end of the day to sit with your financial planner or your financial advisor to discuss what is the best asset allocation, the best asset mix for your portfolio, given your age, your risk tolerance, and your objective in terms of investment. So we encourage you to contact your IA advisor. So to conclude, we invite you to go on our website. Our website, IA, we have the slide deck. We have this 40 minutes webinar. And I want to thank you for the business and confidence you have with IA. And I wish you a very good year 2018. Thank you.